Welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmian, and with me in the studio is my friend Niklas Sävås. How are you today?
I'm fine today. I had this magnificently bad virus last week, but I'm really happy that it's gone.
I'm glad you're back in the studio and that we can record, because today we are eager to speak with a legend, Robert Hagstrom. He is a Chief Investment Officer as well as a Senior Portfolio Manager at Equity Compass. And in 1994, he was the first author to really popularize Warren Buffett in his book, The Warren Buffett Way, which has sold more than 1 million copies worldwide and became a New York Times bestseller. Hagstrom has more than 35 years of investment experience. Prior to joining Equity Compass, he was the chief investment strategist of Legg Mason Investment Counsel, and before that, the portfolio manager of the growth equity strategy at Legg Mason Capital Management, where he managed over $7 billion in assets. Hagstrom was the recipient of honorable mention as Morningstar's U.S. Equity Manager of the Year in 2007. In addition to The Warren Buffett Way, Hagstrom has written several more books on Buffett, as well as The NASCAR Way and The Detective and the Investor. Today we are going to speak to Hagstrom about his book Investing, the Last Liberal Art, first published in the year 2000 and with a second edition released in 2013. Niklas, what is The Last Liberal Art about and why have we chosen this one?
So the purpose of the book is to embrace a multidisciplinary approach to investing where lessons from physics, biology, psychology, literature and more are used to build a kind of a spider web of knowledge that ultimately leads to better decisions. Hagstrom believes that it's not enough to grasp accounting, economics and finance to generate good investment returns over the long haul, an idea which I'm highly sympathetic to.
Me too, and we try to include the multidisciplinary approach and some mental models in most of our conversations here in the podcast. I would especially highlight our discussions with Jake Taylor in episode 2 and Daniel Chang in episode 11, and also with Pete Davis in episode 3, where we talked about dedication and commitments. But who would you say that the book, The Last Liberal Art, is most useful for?
I think all investors could benefit from this view. Especially to get better insights and create better narratives. And I think it's also for other professions where good thinking and decision-making is what matters and that are eager to improve. For me, this is not a subject that you read and forget about, but you need to use it as a manual during the course of your life and increase your knowledge over time.
And how is the book structured?
So each chapter covers the lessons from one discipline, starting with physics and ending with decision-making. The other disciplines covered are biology, sociology, psychology, philosophy, literature, and mathematics. Having read a few books on the topic myself, I think this book stands out from the others by being one of the first and also for embracing simplification. Hagstrom is not bringing up as many models as possible from each discipline, but instead focuses on the core ideas, such as evolution within biology and the law of equilibrium within physics. He also links the lessons to how we as investors can look at financial markets and stock picking.
We are truly proud to have this extraordinary author and investor on the show. Here comes our conversation with Robert Hagstrom. Hello, Robert, and welcome to Investing by the Books podcast.
Thanks very much. Glad to be here.
Where are you today?
I'm actually in Vero Beach, Florida. I enjoy spending the winter season down south where it's a little bit warmer. Back home, I think it's 7 degrees Fahrenheit, so it's a little cold for us.
Sounds nice. So we have to ask you first, being a podcast from Sweden, your name is quite common in Sweden. So what's your heritage?
Well, actually, it's funny that you say that. There are not that many Hagstroms in the state of Pennsylvania. I think there are 3. My great-great-grandfather came from Sweden, was a cabinet maker, and he moved to Kansas in the Midwest. And then from there, my family moved back into Tennessee, where I was born and raised in the state of Tennessee. And I went to school at Villanova University up in Philadelphia, and stayed and married and raised a family there.
And now the dots connect today. And how did your passion for investing start?
Well, that's an interesting story, Eddie. It was kind of a roundabout. I was a political science major in college, which is a liberal arts education when you think about the study of political science, because it is about history and philosophy and psychology and economics. So very much a liberal arts. And I had done some writing in college. I wrote for the newspaper and our college newspaper, and did some writing in a local newspaper, and actually wanted to go to Washington, D.C. and be an investigative reporter. But I didn't much care for Washington, D.C. The politics was not of my taste. And I came back and asked the editor of the newspaper, could I have a job? And he said, well, we can't afford to pay you, but if you're willing to go sell advertising, quarter page ad in the newspaper, maybe we'll let you write a column once a month. And so I walked up and down the main line, which is a street outside of Philadelphia and called Route 30, Lancaster Avenue, knocked on doors. And one day I knocked on something called Legg Mason Woodwalker, members of the New York Stock Exchange. I had no idea what it was. I thought maybe it was a law firm or an accounting firm. And I walked in and I said, could I see the manager? And walked into his office. I said, hi, I'm Robert Hagstrom. Would you like to buy a quarter page ad in the newspaper? And the branch manager said, no, would you like to be a stockbroker? And I said, well, maybe that's a little bit better job than selling advertising. So that's exactly how I got started. I went into training at Legg Mason down in Baltimore, Maryland. We trained for 3 weeks. I thought I'd made a terrible mistake. I wasn't financially literate. I didn't understand finance and accounting. But the next to last night, I read an annual report, a Berkshire Hathaway annual report, which I'd never heard of the company, written by this guy, Warren Buffett, which I'd never heard of. And it was the proverbial light bulb goes on, the way that he explained investing to me as companies, as people, and things like that just made perfect sense. And then that's how my career got started, was following and studying Warren Buffett.
And that was in 1984, right?
Correct. Yes, exactly right. A long time ago.
Nice. And you write in your fantastic book, Investing: The Last Liberal Art, that investment decisions become more certain when ideas from other disciplines lead to the same conclusions. And to set the stage a bit, please tell us what you mean by that.
Well, it's just maybe a psychological. When you get confirmation, what someone else agrees with you, or whatever the case may be, the more confirmation that you get about an outlook, an insight, an idea, other than your own, if you can get additional confirmations, it emboldens your thinking, gives you more confidence. And so, step back, Nicholas, what we're doing is basically looking at the ideas in different disciplines, whether it's biology, philosophy, psychology, literature, whatever the case may be. And if ideas there in those disciplines are in sync with the way in which I'm thinking about the market or a company or something like that, that's additional confirmation. And as I said earlier, that additional confirmation increases your confidence to go forward and act.
And we recently had investor and author Denis Jean-Jacques on the podcast. He highlighted Last Liberal Art as a recommended reading for everyone. And knowing you'd come on the podcast, he sent us a couple of questions. So regarding the multidisciplinary approach, he is wondering how one determines which disciplines to focus on and which are less important when it comes to investing.
Well, the idea originated from Charlie Munger in a lecture that he did back in 1994 at USC, University of Southern California. And he didn't say in that lecture, you don't have to study this, you don't have to study that. He basically said that you should look at all the major mental models and all the major disciplines. So when I wrote the book, I kind of opened it up. If you were a liberal arts major today, you certainly would, you would study, physics and biology, the hard sciences, mathematics, and then you go into the soft sciences, philosophy and psychology and sociology. Now, what we did, though, was also expand it into literature and reading great books programs. So, we thought that was highly valuable. I'd always thought that art appreciation was something that should be added. I wrote a book about detectives many years ago, and I came across a doctor at the Yale University Medical School, and and he had basically said that he split his medical school students into two groups, ones that took the normal coursework, others that took the normal coursework plus art appreciation. And those that had studied art appreciation seemed to have a much better success in doing diagnosis. They saw something else. They were able to see things. So I thought, art appreciation would make a lot of sense. I've since thought about music and how music might play a role. So I'm more apt, Eddie, to want to add disciplines than remove disciplines. I'm kind of like, more information, more ideas from more discipline is better than trying to cut things off. So I haven't really thought about what doesn't work. I'm trying to figure out what could work.
Right. And say you have selected 10 or 15 disciplines to learn about, including finance, of course. And if we see this as a portfolio, how many percentage would you allocate to each discipline?
Great question. I've never had that question. It's interesting. I think we spend way too much time of our daily life just on finance, accounting, reading, financial newspapers, watching financial news programs, and not enough time in the other area. I would think at this stage in my life, at least half of my time is spent in non-financial related readings and investigations, including like podcasts, what you guys are doing, listening to other authors. I don't need to continue to look at the stock market. I don't need to continue to read prognosticators telling me what the stock market is going to do. So I would say almost 50% of my time is spent on reading and studying things outside finance and accounting and economics.
And how much of that would you say is psychology? Because many people focus on psychology.
Yeah, you're really drilling down into the particulars. Well, I think psychology is a huge part. I probably spend more time on philosophy than anything else. I think the work that Amos Tversky and Danny Kahneman have done, along with Schiller, and there's some very bright minds in psychology. And even Charlie Munger, talked about decision making and things of that nature. So I think I've got my hands around that reasonably well. I probably spend more time studying philosophy than I do anything else. Trying to do more biographies. I was underread in biographies growing up, and I find just reading biographies is fascinating. And I'm not too particular. If I read a story about someone, if I can get one or two ideas out of a 300-400 page book, it's well worth the time to read. And so reading a lot of biographies, which in some ways is taking more history courses, is something. So biographies, philosophy. We do a lot of work at the Santa Fe Institute, which I know you may want to talk about. Tremendous amount of science work going on there. So I have a stack of books, and I just try to get through them the best I can. And then when the pile gets low, I have a list of books that I want to buy, and I'll order 6, 7, 8 books from Amazon. They'll show up, and I'll work on that pile. So it's kind of, in some ways, it's circular, but we're trying to make progress.
And one thing that seems central to the Santa Fe Institute is the complexity.
Yes.
And I want to take us back to your own evolution on how to think about financial markets with a lens taken from biology. I mean, that of a complex adaptive system.
Yeah, well, it's interesting. I owe all of these insights to Bill Miller. Bill, as you know, is famous value investor in the United States. He was the only guy to beat the market 15 years in a row when he managed Legg Mason Value Trust, and has had a spectacular career managing a fund called the Miller Opportunity Fund. And Bill is a genuine multidiscipline thinker, and he introduced me to the Santa Fe Institute in the early 90s. And I would tell you both, when I went to the first lecture, I think it was on ant colonies and something else, maybe Navajo Indians or something like that. And I walked out of the meeting and I said to Bill, what does this have anything to do with whether I should buy IBM or sell General Motors? I have no idea what this is about. And he goes, these are not lectures for you to get the answers to those questions. These are lectures for you to think about things differently and understand things differently. And so what happens when you're raised in standard portfolio management, whether you get your MBA or you study economics, it really is a physics-based approach. Reversion to the mean it weighs heavily in our discipline. Historical averages, which we can talk about the fallacy of using historical averages in markets, weighs very heavily. And it's very clear that, we're seduced by the notion that physics is so predictable. I think we are seduced by that predictability, and that's why we're driven to physics-based models. But in reality, the economy and the stock market, like society, is more of a living system, a biological system that evolves, adapts, learns, changes. And all of those attributes, which readily identify what markets are more akin to studying biology than it is physics. And so Santa Fe Institute opened up the study of looking at markets and economies and other things, computers, computer science and on, as a living system that evolves and adapts. And that takes you down a lot of different paths, because you begin to understand that things are in constant change, constant flux, constant evolution. And if you were to anchor to any, kind of correspondence theory of truth that you've got it all figured out now, you don't have to learn anything different, you're going to get left behind. And Bill Miller was instrumental in helping me understand that. So I owe him a deep, deep gratitude. As a side note, I would tell both of you guys, the very first edition of this book came out in 2000. I think the second edition is 2013. But the first edition was actually called Lattice Work, the New Investing, because it keyed off of what Charlie said, build a lattice work of mental models. And I actually dedicated that book to Bill Miller for taking me to the Santa Fe Institute. Well, you remember in 2000, it was the technology crash and then 3-year bear market. And it's actually the worst time ever to bring out a book in the middle of a bear market. If you ever want to have zero sales, bring out an investment book in the middle of a bear market. So the book didn't do very well. But about a year and a half later, I guess we were coming out of the bear market, and my publisher, Miles Thompson, who's still my publisher today, he's at Columbia Business School Press, and he basically said, why don't we change the title to Investing the Last Liberal Art? He goes, there are a lot of liberal arts majors out there. And so we retitled it. If you have a paperback version of the first edition of Investing the Last Liberal Art, which is Lattice Work, he basically ripped off the hardcover and smacked on a soft cover. But if you open it, the pages at the top read Lattice Work, which is the old first edition book. So that's a roundabout story. But the very first edition was dedicated to Bill Miller, who, if Charlie was the architect of how to think about multidiscipline, Bill is actually the person that has lived it, the practicality of it, that's actually tangibly lived a multidisciplined life. And I've learned so much from him.
Really interesting. And as you say, many investors still take a sort of a physics view of markets, meaning stable conditions, despite the constant change that we're seeing in the environment. And some even make market calls such as that the market is cheap or expensive, and some even say things like the S&P should go down to certain levels such as 4,000 or 3,500. What do you make of those kinds of predictions?
Well, I don't think they have much worth. As soon as somebody on CNBC or Bloomberg starts telling me what the market does, I just hit the mute button, because they absolutely have no idea what the market's going to do. Nobody has any idea what the market's going to do over the short run. So that's wasted thinking. I'd rather read a book on philosophy or read a biography than listen to someone who's going to tell me what the market's going to do in the next 3 to 6 months. I think your predictive value on markets goes up to the degree that you extend the time horizon. And it's well pointed out, as long as the economy continues to flourish in a democratic capitalist system, it's likely, over time it goes up about 70% of the time. So, if I were to go to, Las Vegas and play a roulette wheel that had a 70% probability of winning, I could stay at that roulette wheel all day long and make a good living. And that's the stock market. I mean, the stock market is an odds-on bet to go long over time, but nobody has any idea what's going to happen between now and the end of the year, although we spend an inordinate amount of time as an industry talking about it. And I think it is a psychological crutch that people try to lean on, because the idea that you don't know what's going to happen next week, next month is so uncomfortable, psychologically speaking, that if someone were to say to you, yeah, I'll tell you what's going to happen next month, you immediately jump on it and go, oh, thank God someone's going to tell me what's going to happen next month. I'm now satisfied. But they have no idea what they're talking about. So once you understand that, you allocate your time to doing other things and listen to market procrastinators.
And as you said, it's now 10 years ago almost since the second edition of the book came out. And
yeah, 2013. And yeah, I did a lecture not too long ago, and someone would say, would you do another one? And I certainly would, somewhere down the road here. I mean, and I thought about, what would I add? And I would add, an art appreciation course. We'd probably add, music appreciation. I think I would, I would do more on reading, the great books programs, literature. What is literature value? I would do a section on writing. I always thought that writing was a wonderful discipline. And to the degree, and Bill would disagree with me on this. He doesn't like to write. He likes to read. I'd rather spend all my time reading than writing, because writing, I'm writing down what I already know, and I'm wasting time. I want to go figure out what I don't know. But writing is a wonderful discipline, and I think it has many benefits that allow people to clarify their thoughts. My mother used to say, if you write it down, you'll never forget it. And when you do write a commentary, you write a book or whatever the case may be, when you write something, it really does become a part of your soul, your intellectual soul. And you're able to talk about it, I think, a lot more intellectually after you've written something down. So there are other chapters that we could add to the book.
Looking forward to read that. And in the chapter on sociology, you write that equity markets and debt markets have no central controller, and that both are excellent examples of self-organizing, self-reinforcing systems. And after this decade of massive central bank stimulus, we're curious to hear your take on this.
Yeah, good question, Eddie. I mean, I guess, there is no master controller other than, maybe an overriding capitalist mentality of investing to get a cash return. And if you put money to work over time, you expect a return on that money. Maybe that's the master controller in a theoretical sense. But the whole idea about, monetary policy, particularly at the central bank level, whether it's Europe or Japan or US, is really now right. We're really kind of in the eye of the storm of this right now. I know, if you kind of go back to the 1970s, it was a monetarist view. Milton Friedman was given a Nobel Prize that all inflation is a monetary phenomena, that to the degree that you print more money, it causes inflation. And that was true for that particular point in time. It doesn't appear to be true today, 40 years later. Somebody ought to, reach into the coffin and take back the Nobel Prize from Milton Friedman, because that's not that's not true today. Because you can point to a massive amount of printing of dollars, whether it's European Central Bank. Japan is a perfect example. I think Japan's debt to GDP is around 225%, which is twice the level of the US. And they're on the border, right on the cusp of deflation. So they have twice the debt levels that the US does, and they can't make inflation. So I would argue that there are other things at work that would cause inflation or deflation that seem to be overriding, for this point in time, the monetarist view of, if you expand the balance sheet, you print more money, it is a natural occurrence that inflation would naturally follow. That doesn't appear to be holding water right now. And we looked at a lot of this, it seems to be largely demographic, as the world is getting older, particularly in the developed worlds, Western Europe and Japan and the US, the tendency is to save more, spend less. And as savings rates go up, it's looking for a home. And there's some views, Larry Summers, a well-known economist, that, and Bernanke used to talk about this, a glut of savings. There's a lot of money looking for home. And when you have that situation, it does put a lid on interest rates for sure. And we're seeing that. But those interest rates in of themselves, I don't think would be low unless the lenders really didn't have a fear that inflation was going to be hyperinflation like it was in the 1970s. If the bond market thought this was 1970s double-digit inflation, I guarantee you interest rates wouldn't be at 2% here in the US. So the bond market, which is probably one of the greatest markets for efficiency, because you've got so many people, it's highly liquid, so many diverse opinions, wisdom of the crowds, things of that nature. The bond market's telling you, in Japan and Europe and the US, it's not afraid of inflation, no matter what the short-term spikes are. And they're more a function of the pandemic and the disruptions in the global supply chain than anything nefarious that's going to occur over a decade's period of time, in my judgment.
Moving on to psychology, you mentioned in that chapter that myopic loss aversion is the single most important psychological obstacle for investors to do well with their investments. Can you please expand on this?
Well, a lot of work's been done on that. It's basically, and I'm embarrassed, I can't recall the citation, but someone had done this study to the frequency you look at price changes, which is, myopic, right? If you're looking at all your price changes and they go down, and you're constantly looking at them on a day-to-day, hour-to-hour basis, it has more of an adverse impact psychologically, negatively, on your psychological outlook than if you only looked at it once a week or once a month. So the studies are pretty clear about that, to the degree that people look at stock prices or stock price changes daily versus someone who might look at it weekly, monthly, or quarterly. The negative impacts of looking at it each day are far more onerous than the negative impacts of looking at it once a month. Or I would reverse it and say it's more of a positive outcome if you look at price changes once a month than if you look at them once a day. And of course, what we know is now people are, overdosing. I mean, they have it on their phone. They have it, they're looking at the website. They're looking at the office. They have CNBC on, and they look at it constantly. And to the degree that you look at it constantly, it becomes a negative force. And this, I'm going back to Tversky and Kahneman again, prospect theory. If something goes down, it's twice as painful for a unit of loss as the pleasure of a unit of gain. And so markets do go down, or prices do go down. And when they go down, you're twice as discomforted from that price decline than you are for a unit of gain. So, to the degree that you don't look at the market, it's probably, I think, it's Ben Graham that said investors would be better off if there was no stock market. There was no daily, price changes and I used to, kind of wonder myself, and, what if the market was only open once a month, right? And, in a 24-hour period, you can make changes to your portfolio, and there was a liquid market for you to make changes. But after that, you couldn't do anything. Now, some would argue that would make prices go down because, the liquidity actually makes those prices go up because you have a ready market to exchange things. But from a psychological aspect, it'd probably be better if the market were only open once a month. That would work better for investors long term.
Yeah, we would definitely put more effort into study companies. At least, I mean, I think we're all fooled into looking into what's happening on the market instead of doing some fundamental work.
Yeah.
And to go on from that a bit, I mean, loss aversion, or we sometimes hear that just because humans have biases, the stock market is per definition irrational. And I want to hear your take on that.
Well, I'm kind of in Michael Mauboussin's camp on some of this, and others that have written about it. The idea that the Wisdom of the Crowds book was very, very important in that. And this kind of, diverting, this always goes back to when we did work at Los Alamos National Laboratory. I remember going out with Michael in the early 90s, and we met this guy at Los Alamos National Laboratory named Norman Johnson. In the earliest days, he was putting together computer programs of smart agents, average agents, dumb agents to solve particular problems. And when he ran the studies, he found that the most optimal makeup of decision makers to solve a problem was the most diverse. That is, if you had a collection of smart, average, and below average people, they seemed to come up collectively with the best decision than if you dispopulated it with only smart people. So this is Jim Zerwicki's book, The Wisdom of the Crowds. And so if when the market is efficient, it's because it has diverse inputs from all types of people. Where markets become irrational or unstable is when it loses its diversity, when they all become bearish or they all become bullish, and it loses its diversity is probably the time in which the decision making is most at risk. And so I think the markets are reasonably efficient most of the time, either at the market level or at the stock level. What you find, though, that there are periods when the diversity of that opinion of the market or a stock breaks down and becomes one-sided, either too bullish or too bearish. And that's where your financial analysis comes in to take advantage of the price discrepancies that could happen if people were too bullish. You would sell. If they were too bearish, you might buy. But those inflection points occur when there's a breakdown in diversity. as long as the market's reasonably diverse in its opinion, it's usually reasonably efficient. I hope that makes sense.
And what would you say are your most common biases?
Well, I try to check my biases at the door, but I will tell you the mistakes I make. Would that help?
Definitely.
So, there's been a lot of talk about the change in the interest rates in the U.S. from a 10-year that may go from 1.5% to 2.5%. And I think we're 177 today, and the market just had a seizure with the idea that interest rates could go up 100 basis points, and so they basically started to sell growth stocks, which are long duration assets, and mathematically speaking, when interest rates go up or the discount goes up, it does impact long duration assets more so than short duration assets. So everybody sold growth and bought value, and that's fine. I get the mathematics of that, but what the market was failing to do was actually calculate what would be 100 basis point change in the discount rate to the underlying intrinsic value. And what you basically have discovered over the past couple of weeks is that the market prices overreacted to 100 basis point change in the discount rate. What I would also point out to you is that, from 2009, after the financial crisis, to 2019, I think the 10-year pretty much vacillated between 2 and 3% for most of the time. And we had a phenomenal 10-year bull market. And we also had a 10-year bull market where growth stocks outperformed value stocks. So this whole obsession about I got to sell growth because interest rates are going up 50 to 100 basis points, it didn't make a whole lot of sense to me. That doesn't mean the market, didn't want to have that narrative. But I found that my mistakes in my career rarely have to do with anything having to do with the discount rate, whether did I discount it at 10% or 9% or 11%. Right now, just for the record, I discount everything at 10% because that's my opportunity cost. I expect that if I'm going to lend money to the stock market, I should get at least a 10% rate of return. So that's my opportunity cost. That's my discount rate. Never mind equity risk premiums and risk-free rates and modern portfolio theory. I just discount everything at 10. But the mistakes that I made in my career had nothing to do with discount rates. It had everything to do with the competitive advantage period of the company. That is, I thought that they were going to generate a return on invested capital that would last longer, a sales growth that would last longer than what actually happened. So the mistakes that I made in investing are not so much the biases or not so much the discount rates. It's just really understanding the competitive nature of businesses operating in industries, and particularly in the technology space. It's rapidly evolving and changing. And so understanding those competitive advantage periods are the biggest challenge that I have. And that's where I got to spend most of my time.
Going back a bit to the book, you mentioned that it took a lot of effort to write it and that you had to dig deep into disciplines such as philosophy that you were not that familiar with before. Why is philosophy important for investors? Well,
and here I'm going back to Bill Miller. He did his doctoral in philosophy at Johns Hopkins and worked through the entire doctoral program absent his dissertation. And he was heavily influenced by people like William James, the father of American pragmatism. And so if you really want to think about investing from it, so, we can go back to biology, if you kind of think of a Darwinian aspect of markets are evolutionary in nature. Pragmatism is the philosophical instrument to help you navigate a biological environment, right? It continually evolves and changes. And so therefore your thinking must continue to evolve and change. And so he would talk about the cash value of ideas. And so you're trying to, as Bill says, I'm just trying to figure out what works, what's working right now, what's making money, where are the profits, instead of getting hung up on what you think it should be going on because you have some correspondence theory of how you think the world works. The world is always changing, and pragmatism becomes the instrument that allows you to navigate an ever-changing world. So, we spent a lot of time on pragmatism, but the one that really stuck with me was the Austrian philosopher Ludwig Wittgenstein. And, a 20th century, great thinker. I think it was Bertrand Russell, who was no slouch himself, that said that, Wittgenstein was probably the greatest example of genius that he'd ever seen. And interesting, he only wrote one book, Practice. The second book, Philosophical Investigations, was actually published posthumously after he passed away. His friends collected up all his papers and some of his lecture notes and put this book out. And it's a phenomenal book, not very long, a couple hundred pages. But in there, he basically wrote a picture of a triangle. He had a diagram of a triangle, a simple, geometric diagram. And he, pointed out, what can you say about this, about this diagram? And so, you kind of think about it for a second and you go, okay, he's trying to get me to describe this thing in different ways. And so when you go through it, and if you read in the book, basically what he said was, I can look at this thing as, a triangle. I can see it as as a triangle that has a hole in the middle. It's a geometrical drawing, to be standing on its base, hanging from its apex, a mountain, a wedge. I think he said an arrow, a pointer, an overturned object, many different ways. I think there were 12 different descriptions of a triangle that he came up with. And basically what he was saying, his philosophy was not only mathematics and language, it was language. And he basically says the words that you choose form a description of what you think is going on that ultimately becomes the explanation of what's going on. So kind of reverse engineer it. What he's basically telling you, if you choose the wrong words, you have the wrong description and the wrong explanation. So, Benoit Mandelbrot at the Santa Fe Institute, when this discussion was going on, he did fractal geometry and, the father of fractal geometry. And he bellowed out from the back of the room, said, failure to explain is caused by failure to describe. So every mistake you make as an investor, typically your explanation is wrong because you have the wrong description. So what you have to think about from a philosophical standpoint, from Wittgenstein's standpoint, is do you have the right description? So, go back, to Eddie's question, is the description that, we printed too much money and that's going to cause hyperinflation? That's one description, right? I've chose the words to form a description, and this is my explanation. Well, if your description's wrong, your explanation's wrong. So do you have the right description? And so I spent a lot of time in my thinking, not only at the company level, but economically speaking, markets and things of that nature what are the current narratives? Robert Shiller, Nobel Prize, wrote a book called Narrative Economics. What are the current narratives in the market? And are those narratives good descriptions? Yes, no. And those narratives are forming a description which is giving you an explanation of what they think is going to happen. If you think about it, you're trying to figure out, is the market narrative right or wrong? And if it's wrong, there's your source of mispricing. If it's right, maybe there isn't any mispricing. So philosophy, in so many different levels, from William James' pragmatism to Wittgenstein's theory of language, and how it impacts descriptions, explanations, and narratives, is hugely important to be a successful active manager. I know that was long-winded, but I'm really passionate about that.
I can notice. So you've been studying the multidisciplinary approach for decades.
Yep.
And I can't think of any better to ask how you practically use this as a portfolio manager.
Well, hopefully this entire podcast is kind of leaning towards, how we used it, at the meta level, right? At the level of, how we think about it. I think we used an example in the book, about Amazon, and this goes to Wittgenstein, right? When Amazon came out, Bill and I, owned Amazon at the IPO, and two things were going on simultaneously. One is that Bill had made a ton of money in the 1990s owning Dell Computer, which was a direct distributor of personal computers to individuals, and he sold at prices below, Compaq, Hewlett Packard, Gateway. And you bought them over the 1-800 number. You got your credit card that night in the bank account. But they didn't have to pay the chip suppliers or the monitor keyboard for 30 to 60, 90 days. And so he basically had a wonderful business of growing the business on the accounts receivable of his customers, what ultimately became negative working capital, and was the very first company to generate 100% return on capital. So that stock went up 10,000% in the decade of the 1990s. When we went into Amazon, a couple of things were going on simultaneously. When we did the work on Amazon and Bill, talked to Jeff Bezos, Bill asked him, what is the business model? And Jeff said, well, it's kind of like Dell, which is, I get books. I sell books, but I don't have to pay the publisher for 90 days. And sometimes I can give the books back with no penalty. And so when Jeff began to describe, so he's describing his business as something in Dell, we knew we were home free, right? We just said, well, this is a wonderful business model. But then you go to the market level, and how was the market describing Amazon when it initially came out? They describe it as Barnes & Noble, a brick and mortar superstore that sells books. And they looked at the accounting factors, which is a stupid way in which to analyze businesses, just accounting factors alone, and said, the price earnings multiple is lower. The price to sales is lower in Barnes & Noble, and it's way too high in Amazon. So you should, buy Barnes & Noble and sell Amazon. Well, that didn't work out too well. That wasn't a very good way to do it. And then it started doing, appliances and, CDs and furniture and all these things. And they, oh, no, it's not Barnes and Noble, it's Walmart. So description of Amazon is Walmart. So you should do a pair trade, go long Walmart and sell Amazon. Oh, well, that was a horrible investment to make because the description was totally wrong. But those that understood AOL is kind of a Dell business model, understood that, something that earns 100% return on capital could be priced at 50 times earnings and still be undervalued where the market thought it was grossly overvalued. Well, that all leads back to Wittgenstein, right? And so clearly, the study of philosophy has made a lot of money for guys like Bill Miller, and I piggyback those ideas. But, I'm trying to figure out what is the right narrative of these stocks, and does the market have it wrong? And it's all back to descriptions, Wittgenstein, and then having a pragmatic viewpoint that it's always evolving and changing, and you need to be evolving and changing, and you can't get hung up just on one viewpoint.
I think that's a great summary of the whole discussion. This being a book podcast, as us, we know that you love to read. Which books have been the main inspiration for you?
Well, all the, as I said, the books. I read all of the James biographies for sure. I'm looking up on my shelf. The book that's one of the favorites in our group, the Metaphysical Club by Louis Menand, is the whole history of pragmatism from Oliver Wendell Holmes, Charles Sanders Peirce, William James, on through the line. That was terrific. What else have I been reading? The biographies of Oliver Wendell Holmes, read that. This great book called Immunity to Change that Kaplan had written about, immunity to change is your ability to actually change. That was a good book. I'm looking up on my shelf. I read all of Mauboussin. Anything that Mauboussin writes, I consume. I think that's wonderful. What else? From time to time I read, Sherlock Holmes. I always like reading, I have his, collection right up here, and I, from time to time will read different short stories. Sherman Kent's, it was written in the 1940s about strategic analysis, is a good way in which to think about how to capture data and organize it in such a way. So, we cast the net wide, do a lot of work on stoicism, because you really have to have a stoic mindset, I think, to do well in markets. And so, it really is a catch-all, everything different types thing. And it's whatever you're in the mood today to read, I'll grab something on the library. I just went through Christopher Hitchens' essays called Arguably. And Christopher Hitchens had passed away a number of years ago, but probably one of the greatest American essayists out there, and just a brilliant way in which he has to form arguments. So, it's a little bit of everything, guys.
Is there something you avoid?
I don't read romantic novels. Somehow or another, I just can't get into, Bronte and Wuthering Heights and stuff. I just can't go down that path. I try to read them, but I just can't get through them. So, I really try to be open-minded, both fiction and nonfiction, but romantic novels I just can't seem to get through anymore.
Thank you, Robert, for a fascinating conversation about you and your book. Do you have something more you want to add before we finish up?
No, I just when the young people, we sponsor a lot of interns and with things like that. We do two things, which is, you got to read. It's, this is not LinkedIn and Twitter and emails. You've got to read. And I don't know anybody in this business that isn't successful, as Charlie Munger said, that hadn't done a lot of reading. So you got to go back to it. You may think it's laborious, but it's not. And you've got to be a reader. And then I would tell them, write down what you're thinking about. Write down, what you think is important. And those writings, become very important. It can be a source to your resume. I said, these kids have got tremendous resumes. They go to great schools. They got great GPAs, they great internships, and they put down the resume in the employer's desk. And he's looking at it. And he's got 12 of them that look just the same way. And I said to him, if you ever write a research paper or a commentary, something you think is really, really good, then attach it to your resume and say, hey, this is something I wrote. I think you might enjoy this. That alone is going to make you distinguished amongst a pile of resumes that are indistinguishable. So read and write. And if you do that consistently over your lifetime, there's no doubt in my mind you'll do much better. There's an old cliche that the liberal arts major is for the Middle Ages, because it's not until you're middle aged that you begin to understand how valuable it is. So you're 20 years old today, you just graduated. I know you're a specialist, but if you want to be successful 20 years from now, you need to be multidisciplinary in your thinking, no doubt.
Great. And where can our audience follow you and buy your books?
Well, we work for Equity Compass. I'm the CIO of Equity Compass. Our website is www.equitycompass.com. And we have our commentaries there, bios and things of that nature. That's probably the best way for you to kind of keep up with what we're doing. I post my commentaries there, my bios and things like that. That would be a good place to start.
Thank you so much, Robert, and have a great day.
Good luck, guys. Thanks for the invitation. I enjoyed the conversation.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.